Good morning, everyone. Thank you for joining. And I'm sure, as every speaker has said, it's a shame we're not all together in Monaco, but we will make do with this new world. So what I'll do today, as Charlene said, is give a discussion on where we are with regulation and where we're going in the ETF space. As always, people are encouraged as I speak to ask questions through the functionality on the platform. Otherwise, I will just continue to talk at length. So where we are 2 years out from MiFID II is wondering if regulation has delivered what we thought it would for ETFs. And I guess the simple answer is yes and no. So when MiFID II came in, there were a lot of people out there claiming that it was going to be sort of the needed ignition or spark to really propel the European ETF industry. And certainly since 2018, the ETF industry has grown quite a bit, though it's not necessarily, or it's hard to determine if that's specifically because of MiFID II. Now, there have been definitely been some upsides to MiFID II. So the components that really impacted ETFs, such as the trade reporting, transaction reporting, was incredibly helpful for the ETF space because it demonstrated and showed that the European ETF market was far more liquid and deeper than people had originally thought, or that was visible to market participants. And this is because of the nature of the ETF market in Europe, where about 70% remains sort of off exchange trading. So definitely the MiFID II transaction reporting has done what it was designed to do, which is sort of give investors, and particularly institutional investors, a better idea of liquidity in the European ETF market. The elements that haven't worked as well as I think people had hoped were the more, I would say, slightly nuanced hopes. So, for example, in MiFID II, there was a limited ban on inducements for fund sales, and there had been hope, and I'm sure if some of you have seen me speak in years prior, I echoed that hope that sort of the move away from inducement-based sales for financial advisors would favor products such as ETFs when it comes to sort of delivering solutions to the end retail clients. In truth, we haven't really seen that materialize to date, and there are a couple of reasons for that. One, as probably everyone knows, the European ETF market is heavily slated to institutional, and not as heavily going to retail, and that's sort of not unique to the ETF market. That's sort of the European fund space, where the retail component, or sort of direct retail component, is far smaller than you would see, for example, in the US. And secondly, the inducement ban, as being the product of the Brussels legislative machine, was a compromise and not as far-reaching as as other regulatory actions we've seen, such as in the UK, with the introduction of the RDR, which was a far more sweeping prohibition around inducements and commissions for fund sales. So that hasn't delivered what I think people had hoped it would. And then the final element of regulation that happened a couple of years ago that did benefit European ETFs, though I would argue it wasn't as intentional as the MiFID II moves, was the introduction of PRIPS. So under PRIPS, all non-UCITS funds need to produce a key investment, a KID document, pre-sale document, and what for any funds that are sold to retail investors. And so what this sort of ended up exposing or catching was a number of US ETFs that were being sold into retail channels in Europe. And because these US ETFs did not want to sort of register and produce KIDs, they were all sort of pulled from the market and no longer allowed European investors into them. So that naturally led some of those investors to move to European ETFs. However, I would argue, and I'm pretty sure the commission would argue, that wasn't, strictly speaking, the intent of PRIPS, but it was a sort of an unintended consequence that sort of exposed an area of distribution of US ETFs that was previously not as well known about. So that's sort of where we are in terms of what happened and what shouldn't happen. And I think what I'd like to do now is sort of talk about the current environment and what regulatory changes are coming that will impact the ETF marketplace, and then sort of look forward as well. So one of the reasons that ETF trading, one of the challenges with European ETFs and trading As many know, despite all sorts of lofty claims about single markets in the EU, the trading remains incredibly fractured across national lines. And so, for example, ETFs are traded in 20-something exchanges across Europe, and there is no sort of consolidated view of this trading. So originally proposed in MiFID II is this concept of the consolidated tape that would sort of give price and volume across all exchanges and all trading venues in one single location. The idea behind this is it would give everyone a much clearer idea of the true sort of size of the market, better price discovery, encourage more trading and more harmonization. It was proposed under MiFID II. It did not go anywhere. It has continued to be a hot item in European policy circles. And just a couple of weeks ago, the European Commission released its roadmap for its Capital Markets Union, CMU 2.0, or I prefer to call it more of a CMU reboot because it's trying to do a lot of stuff the first CMU didn't quite accomplish. And as part of that project, the Commission has revived the idea of creating a consolidated tape. I think everyone in the industry would welcome the consolidated tape, but we shouldn't minimize the challenges that still remain. So one of the big issues with the consolidated tape is it brings up this idea of sort of what data is public and what data is private or proprietary to exchanges. So as many of you know, a big part of the last 5 to 10 years has been exchanges looking to monetize the data they have and sort of charge for data. Is sort of tritely has been said, data is the new gold or new oil. So people are looking to sort of take advantage of that. And so there's this sort of tension between policymakers, the market, and exchanges on what data they have that should be public and what data is proprietary. And in order for the consolidated tape to really work, the Commission is going to need to ensure that a certain basic level of data is publicly available and can be put into this consolidated tape. The other main challenge with creating the consolidated tape has to do with sort of the nature of the EU, in that there would be right now no single supervisory body to oversee the consolidated tape. And as the status quo is, it would be each of the national regulators would need to enforce adherence to standards and deal with sort of price with data issues. The obvious solution to that is to sort of move that supervision from the member state level to, for example, ESMA at a European level, in the same way benchmarks are now regulated at a European level. And I think everyone in the industry and regulators would agree with this, but it's always a challenge when you're sort of federalizing regulation in Europe. So that will be a tricky element of the consolidated tape. And so where we are now with the CMU is that it's been proposed. Consolidated tape is one of 16 core action items the Commission is looking to achieve. And sort of the industry will be sort of waiting to see sort of the more detailed proposals. Now, Europe is not alone in struggling with this consolidated tape. The SEC in the US has been trying to do consolidated audit trail for the last 5 or 6 years and has continued to run into a number of the same issues around data availability and how do you sort of, who pays for it and how does it work? So it's not unique to Europe necessarily. And in the US, as you know, it's a lot easier when you essentially have a handful of a couple major exchanges to deal with. So the consolidated tape, if it goes through, would be a huge help to the European ETF industry and continue to sort of help make trading a lot easier and continue to show the sort of true depth and liquidity of the marketplace. From a policymaker perspective, which hasn't materialized yet with MiFID, there would be this hope that all this information would encourage more ETF trading to be on exchange rather than off exchange. But for right now, there has been no sort of definitive trend to trading moving on exchange in ETFs, and a lot of it continues to be OTC. The other part of the CMU that is important for ETFs is the concept of inducements is again coming up. And so a big part of the CMU is around investor protection and sort of making sure investors get the best outcome from their investments. And so the idea of do inducements or fund commissions need to be tightened or looked at again is raised in the commission's CMU action plan or roadmap. And so that will be another, theoretically, any move to sort of tighten up the rules around fund commissions and ETFs fund commissions should benefit ETFs. Though, fool me once, shame on you. Fool me twice, shame on me. I would remain sort of hesitant to say that would actually move the needle until we see what those rules look like and how tight they really are. I think for ETFs, the macro part of the CMU that is really important is that this one of the core goals is to get more retail participation in capital markets, and obviously mutual funds and ETFs, the asset management industry more generally, is sort of basically the key conduit to that goal. So one of the big issues in Europe that remains, or was addressed, they were trying to address the first version of the CMU, they continued to try to address, is that it's the amount of funding of the economy in Europe it's roughly 80% bank-led, whereas in the US, it's about 20% bank-led. So basically the exact opposite. And so what the commission really wants to do is get more retail and household investment into capital markets, not through the banking channels. So this would be a huge boon to the asset management industry to allow for that. And a key part of the CMU is for increased cross-border consumption of investment services. So we're really knocking down any remaining barriers around the distribution of ETFs or UCITS across Europe. So at macro level, that would be a huge boon. If more retail participation comes into the European asset management or fund space, that should be a huge boon for ETFs because of the sort of the competitive cost pricing nature and how they can really sort of deliver value to retail investors. Now, that is not going to be something that can be sort of waved through immediately. And it has been a goal for the last 10 years of European policymakers. So it's not necessarily going to happen overnight, but I think that is something as an industry we should be aware of, that's the objective in the CMU that could really help the ETF space. So at a macro level, that's what's happening right now and what we need to look forward to. And so the CMU action plan was published, and there will be a number of sort of work streams and individual regulatory or legislative proposals that come out of that the industry should really pay attention to. And I would say, in particular, around the consolidated tape, when or if there are consultations on it, rowing in behind and really supporting that would be a huge benefit to the industry. So if I pause there, no questions have popped up yet. Everyone's probably still enjoying their morning coffee, but what I will now do is pivot a little bit and talk about what potential developments we might see or what sort of regulatory that could help the industry and what sort of trends we sort of are tracking at sort of a bigger level. And so one of the things I think most people in the industry are very interested in is, are we going to see sort of active, non or semi-transparent ETFs in Europe? So since I spoke, we all gathered for Insights Europe last year. The SEC in the US has approved a number of models for active, non-transparent or semi-transparent ETFs. And so these are ETFs that are sort of actively managed and do not have to do the daily full transparency disclosures of their underlying portfolio. The goal, obviously, is to encourage more active managers to create ETFs and sort of protect their investment strategies from being front run. So the question now, so there have been 4 or 5 models approved in the US, and we've seen a number of fund launches. Now, in all honesty, none of them have sort of caught fire yet. It's going to be sort of a slow burn to build assets in that sort of product, but it is sort of innovation that has been sort of led or allowed by the regulators in the US. And I think the question I'm always asked is, will we see that in Europe? And so the short answer is probably. The longer answer sort of is a little more nuanced. So in 2017, 18, the Central Bank of Ireland which is sort of the lead regulator for ETFs in Europe, released a paper around sort of what proposals for the ETF industry, and it raised and decided not to take action on sort of allowing for active, non-transparent ETFs. The decision at the time was based on the fact that, in some part, because the SEC had not yet made its decision, and sort of at a global level, the Irish and U.S. regulators are trying to be a little more coordinated in principle around ETF regulation through IOSCO forums. However, now that the SEC has acted, there's an expectation that certainly in Ireland, the central bank will likely revisit it, or is revisiting the topic, I should say, around how they would allow these products to exist. So I think what we can expect in the next, when we gather again, hopefully in person next year, is that the central bank probably will be close to, if they had not already, sort of changing their rule set to allow for active, non-transparent ETFs to exist in Europe or in Ireland. I do not believe in the short term we're going to see a European level decision. I think it's going to continue to be sort of a member state decision process. And I think if you look at the European ETF market, it's essentially two domiciles, and it's really one. It's Ireland and Luxembourg are your two main domiciles for ETFs. And so I would expect if the Central Bank of Ireland allows non-transparent ETFs, that the Luxembourg would quickly follow suit. The other question that we're frequently asked is around this concept of creating share classes within ETF share classes within existing funds. There had been this is sort of a process that's currently proprietary to Vanguard in the US, where they hook up their ETFs into their existing index funds. And there's obvious benefits of economy of scale for groups if they would be able to do this. Unfortunately, this I have less hopeful news on because of the rules around shareholder fairness and how ETFs need to be treated. Shareholders in each share class need to be treated equally. It seems unlikely that we are going to see the ability for an existing mutual fund to create ETF share classes. Now, the Central Bank of Ireland has indicated they would allow it the other way, where an ETF can have sort of an ETF share class and a non-ETF share class. However, for asset managers and manufacturers, that doesn't really solve for the ability to leverage existing scale for their fund products. So I think that probably will be less likely to happen in the near term. So I think really on the innovation product side, it's sort of waiting, and there's a number of applications in front of the Central Bank of Ireland to create this non-transparent ETF. And then we'll see, as we will continue to watch in the US, what the investor demand really is around for those products, and how asset managers will introduce them into their product set. Because they essentially, if you're an existing asset manager, active manager, you are basically introducing versions of your funds at a lower cost point. So there is sort of a delicate balance around and a consideration around the overall business case when introducing these funds. However, I think everyone in this room will probably agree that ETFs continue to be sort of grow because they are flexibility, because they offer their investors sort of what they are looking for. That the ETF wrapper around an active strategy is inevitable, and it would just be a matter of time and how it will grow, how quickly it will grow. So that's sort of one of the sort of product level macro things we're looking at. And then I will finish off. Again, please text away if anyone's out there with questions, and say a quick moment on the sort of an even higher up regulatory considerations as an industry we should look at. And so one of the things, as everyone here knows, that is front of mind of regulators and policymakers is fund liquidity, the appropriateness of daily liquidity in all mutual fund strategies, and then how then the corollary to that, or extension ETFs, is sort of the intraday liquidity. And is there any sort of risk or systemic risk with this liquidity being offered to investors versus a potential mismatch with the underlying portfolio. Now, when we went through the incredible COVID volatility in March and early April, I think ETFs answered one of the questions that's always been out there about would ETFs exacerbate a volatility in a marketplace. And I think even the most hardened cynic about ETFs or critic of them would say that the ETF industry passed a test incredibly well, and especially fixed income ETFs have been sort of noted by policymakers as being sort of helpful to provide bond liquidity when it was needed, and did not exacerbate sort of any volatility or liquidity issues. And so that's a huge proof point for the industry, because one of the ongoing works at sort of an IOSCO level and at a European level is considering, is there systemic risk about ETFs specifically that need to be addressed? And I think we have as an industry always said no, but I think we can now more confidently say no with a sort of basically a case study of what happened earlier this year. Notwithstanding that, there will continue to be work at sort of a IOSCO level, which will trickle down to a European level, about asset management in general. There, as it's continuing to grow, ETFs continue to grow within asset management, and what additional risks is that going to pose to the financial system, and do any additional controls need to be put in place? And IOSCO has been looking at this for 2 or 3 years. I've given up saying when they're going to release the report because I've been wrong for the last 3 years. But it is something we should continue to monitor as an industry to see if they suggest any more ETF specific regulations, because right now, especially in Europe, their ETF regulations are essentially an addendum to the UCITS regulations, and there are no real specific rule sets. And so that's something we should continue to monitor as an industry, though I think it's less of a concern than it would have been a year ago, like, as I said, given the sort of events that have transpired. So I'm going to pause for breath. So if there are no questions, I will sort of sum up by saying that regulation will continue to drive and shape the industry. I think for now, it is more of a tailwind than a headwind. So the risks of regulators coming up with more restrictive rules around ETFs has probably abated in the last year. And now I think it's really about what regulation, especially in Europe, what regulations might be brought in that could directly or indirectly provide further tailwinds to the ETF industry. So I think it's a good place to be for the industry to not be sort of trying to defend against sort of overly burdensome regulation at a product level, and really be sort of the beneficiary of regulatory action. So I would say that that's essentially where the industry is. There's obviously hundreds of other regulations going out there that could indirectly impact it, but for ETFs, that's sort of the main thrust of it. And so I think when we gather again next year, the big things they see is how far along the consolidated tape has come, what the inducement proposals in CMU looks like, and then sort of any changes that might happen to the UCITS framework, which could sort of indirectly impact the European ETF space.